Municipal bonds don't get much hype, but for income-focused investors, they can play a powerful role in a well-constructed portfolio. Today, we're exploring municipal bond ETFs, why investors use them, and 5 of the most well-known examples designed for stability and tax efficiency. This is the ETF Investor, and if you care more about reliable income and risk control than chasing headlines, this one's for you. Municipal bonds are issued by state and local governments to fund public projects like schools, roads, and infrastructure. The key attraction is that the interest income is often exempt from federal taxes, and in some cases, state and local taxes as well. That tax advantage can significantly boost after-tax returns, especially for investors in higher tax brackets. Municipal ETFs package hundreds or even thousands of these bonds into a single, diversified fund. Instead of worrying about credit quality, maturities, or reinvestment risk bond by bond, investors get instant diversification and professional management. Let's start with one of the most popular options, the iShares National Muni Bond ETF, ticker MUB. MUB provides broad exposure to investment-grade municipal bonds across the United States. It's often used as a core municipal holding due to its size, liquidity, and focus on high-quality issuers. The trade-off is relatively modest yields, but that's the price of stability. Next is the Vanguard Tax-Exempt Bond ETF, ticker VTEB. This ETF is similar to MUBI in scope, but typically comes with a lower expense ratio. VTEB appeals to long-term buy-and-hold investors who want broad municipal exposure with minimal costs. Performance tends to closely track the overall municipal bond market. For investors willing to accept slightly more credit risk in exchange for higher income, there's the SPDR Nuveen Bloomberg High Yield Municipal Bond ETF, ticker HYMB. This fund focuses on lower-rated municipal bonds. Yields are higher, but so is sensitivity to economic downturns. HYMB may work better as a satellite holding rather than a core position. The fourth example is the Van Eck Intermediate Muni ETF, ticker ITM. This ETF targets intermediate duration municipal bonds, balancing income and interest rate sensitivity. It can be a solid option for investors concerned about rising rates, but still looking for tax-exempt income. The fifth ETF is for investors in higher tax states who want state-specific exposure. The iShares California Muni Bond ETF, ticker CMF, is one example. There are similar ETFs for New York and other large states. These funds offer double tax exemption for in-state investors, but come with less diversification due to geographic concentration. Now let's talk risks. Municipal bonds are generally considered safe, but they're not risk-free. Rising interest rates can pressure prices, especially for longer duration funds. Credit risk exists, particularly in high-yield municipal ETFs, and liquidity can tighten during periods of market stress. Municipal ETFs also make the most sense in taxable accounts. Holding them in tax-advantaged accounts like IRAs often eliminates their primary benefit. The bottom line is this: municipal ETFs are about stability, income, and tax efficiency, not growth. They're best suited for conservative investors, retirees, or anyone looking to reduce portfolio volatility while keeping more of their income. If you found this breakdown useful, subscribe to the ETF Investor and let me know in the comments which type of income ETF you want covered next.